Hello, friend and future deep dweller. Lately, I've been noticing something strange in my own behavior. I'm taking less risk than I used to. At 34, that feels premature, especially when it comes to investing. Sure, it depends on context, goals, capital, and all that, but still, it made me wonder, do we naturally grow more risk averse as we age? I'm definitely not talking about risk in terms of physical activities. I've long since retired from doing crazy stuff, but this shift in my investment behavior made me think, is there a general pattern here? As investors get older, do they start pulling back on risk too? As we talked about in an earlier episode about the risk and return trade-off, which we learned is messy and inconclusive concept at best. But let us assume for a moment that it holds. So if you do reduce risk, your expected return should also go down. So if investors do become more risk averse with age, there is a built-in force nudging their returns downward over time. But on the other hand, there is this counter argument, the intuitive one, at least I think so. So as you get older, you gain experience. And with more experience, you've seen more cycles, made more mistakes, absorbed more lessons, hopefully. And that should, in theory, lead to better investment decisions. More skill, better judgment, and higher returns. Maybe both of these forces are at play. So risk aversion pulling returns down, experience pushing them up. And maybe at some point they interact, so a peak. Beyond that peak, even if experience keeps compounding, something else begins to erode performance, mental sharpness, reaction time, creative energy. Whatever it is, it slowly begins to decline faster than any learning can keep up. So performance flattens and then fades. This is the shape of a concave relationship between age and performance. The peak at 47 in the graph shown is just a stylized example. But the broader point remains, experience does not necessarily scale forever. But I did find an interesting study that suggests this kind of relationship does exist, so at least for surgeons. So the author showed that patient mortality was 14% higher when surgeries were performed by older surgeons compared to middle-aged ones. Perhaps investor performance follows a similar trajectory. And if we're going to test that idea, why not look at two of the best, Warren Buffett and Peter Lynch? With the help of ChatGPT, I wrote Python code to extract the annual return of Berkshire Hathaway and the S&P 500 all the way back from 1970 to 2023. And I did the same for Peter Lynch Magellan Fund, although he only managed it from 1977 to 1990. And to smooth out the annual fluctuations and focus on performance over time, I converted the returns into 5-year rolling averages. Since we are interested in investment skill, which I believe ideally is captured by alpha generation, so above market returns. And I define that as abnormal returns as performance of the fund or the company minus that of the S&P 500. So a simple example would be if Berkshire Hathaway managed to achieve a return of 20% in annual returns 1 year and the S&P 500 delivered 10%, then 20 less 10 would equal 10. So the above market returns or the abnormal returns or the alpha, whatever you want to call it, is 10% for that year. And yeah, I know I could have chosen other benchmarks than the S&P 500. We know that Buffett is a value investor, so we could have used a value index or created our own. And for Lynch, which was more a small cap focused, or at least in terms for the benchmark, perhaps that would make more sense. But just for simplicity's sake, I kept it to the S&P 500. This is just an exploratory exercise. So, in the first graph you see now, it shows the annual returns of Berkshire Hathaway versus the S&P 500 from 1970 to 2023, and it jumps a bit all over the place. Yeah, and the next graph I show is just I plotted the 5-year rolling returns. So for both Berkshire and the S&P 500, just to make it more visually appealing and easily to spot the trend. And then came the key metric, the one you see now. So the 5-year rolling abnormal returns for Berkshire And here the pattern is unmistakable. A steady decline in alpha generation over time, even negative in the past couple of years. And let's not get too hung up on the specific details of this. It is the trend that we are interested in. Okay, so we can see that there's a clear decline over time for Berkshire Hathaway. Now let's turn to Peter Lynch and the Magellan Fund. So we will skip the annual returns and simply go straight to the 5-year rolling returns for the Magellan Fund and the S&P 500. And I also gray shaded region where Peter Lynch was running the fund. So his tenure from 1977 to 1990, you can see he did extremely well, or the fund did extremely well during that time period. And afterwards, yes, there's a decline. And then finally, we look at Magellan's 5-year rolling abnormal returns. So here too, we see a clear decline in alpha generation, both during and after Lynch's tenure. And I know these are just 2 anecdotes, but they do cover some of the world's best investors and a long time period. So perhaps this simple analysis lends some support to the idea that returns do not age well. So that investors, even the great ones, lose a bit of their magic touch over time. I did find another study backing this up, Chevalier and Ellison in 1999. So they show that younger fund managers outperform older ones. One explanation the author offer is that younger managers work harder since they are more likely to be fired for poor performance. Perhaps there's some truth to that, but I also think appetite for risk declines with age, as I started this episode with, and also with wealth. So when you're rich enough, the incentives to compete just aren't as strong anymore. You've already won, so why risk it? And then I also believe there's the size effect. So when a fund becomes too large, it can be hard to invest in the same sort of nimble way that generated the high returns early on when the assets under management were simply considerably less. And then prior success attracts more capital, which ironically makes it harder to repeat that success. All of these are just ideas, plausible reasons for the decline in alpha. I'm sure there are plenty of others, but in summary, this basic analysis shows a clear and consistent pattern of declining abnormal returns over time, and likely a concave relationship between age and investment performance, just as we've seen in the world of surgery.